Gold and silver have long been valued as tangible stores of wealth, but their true utility in investment portfolios lies in their liquidity. Liquidity is the measure of how easily an asset can be converted into cash without a significant loss in value. In the case of gold and silver, liquidity determines how quickly and efficiently investors can trade these metals, which is essential for managing risk and capitalizing on market opportunities. In highly liquid markets, transactions execute swiftly, and the spreads between buying and selling prices are narrow. This is because there are many active buyers and sellers, which ensures that orders can be filled with minimal price impact. Investors who understand liquidity can make more confident decisions, knowing that they can enter and exit positions without causing major price swings. Gold, in particular, benefits from strong institutional support and global recognition. Central banks around the world hold large reserves of gold, which helps maintain a stable and deep market. This institutional backing ensures that gold remains a liquid asset even during periods of economic uncertainty. As a result, gold's liquidity tends to remain consistent across different economic cycles, making it a reliable store of value. Silver, on the other hand, has a different. Most people arrive after the move is obvious and the easy upside is gone. We focus on serious crypto education and high-quality signals before the crowd rushes in, so you can understand the setup earlier and move sooner. If you want that edge, visit the link below now. Dynamic. Its liquidity is closely tied to industrial demand, which is more sensitive to economic activity. When industrial sectors such as manufacturing or electronics slow down, the demand for silver can drop sharply, reducing market depth and increasing volatility. This means that silver's liquidity can be more volatile and less predictable than gold's. The structural differences between gold and silver markets also affect their liquidity. Gold is continuously traded on major financial exchanges and through over-the-counter channels, ensuring a constant flow of transactions and stable pricing. Silver, however, is often traded in more specialized or regional markets, which can lead to wider spreads and slower execution times. This difference is especially noticeable during periods of market stress or economic downturns, when the demand for silver declines and liquidity becomes more challenging to maintain. Liquidity also plays a crucial role in the execution of large trades. In deep markets like those for gold, large orders can be executed without significantly affecting the price. This allows investors to move in and out of positions with minimal cost pressure. In contrast, silver's liquidity can struggle to accommodate large trades, especially when market depth is low. This can lead to higher transaction costs and increased volatility, making it more difficult for investors to manage large positions effectively. For investors, understanding liquidity is essential for managing risk and optimizing returns. In markets with high liquidity, investors can execute trades more efficiently and with less uncertainty. In less liquid markets, even small trades can cause price movements, increasing the risk of slippage and execution delays. The next key signal to watch is whether industrial demand for silver stabilizes or rebounds. If industrial activity picks up, it could lead to improved liquidity in silver markets and reduce volatility. Conversely, if demand remains weak, liquidity in silver could continue to be a challenge for traders, and most people arrive after the move is obvious and the easy upside is gone. We focus on serious crypto education and high-quality signals before the crowd rushes in, so you can understand the setup earlier and move sooner. If you want that edge, visit the link below now. Investors. In the gold market, the focus will be on institutional activity and central bank behavior. If central banks continue to increase their gold reserves, it could signal sustained demand and support for gold's liquidity. On the other hand, if institutional interest wanes, gold's liquidity could face pressure, especially in periods of market stress. Ultimately, liquidity in gold and silver is a critical factor for traders and investors. It affects transaction costs, execution speed, and the ability to manage large positions without unduly impacting the market. As market conditions evolve, investors should monitor liquidity closely to make informed decisions and manage risk effectively.